Welcome to Alpha Recap, your after-hours rundown of the biggest market moves. Markets closed for the day, and we have a lot to unpack. As always, if you have questions, you can reach us at stockalpha.ai.
Good to be here. Big headlines today, a major utility merger, and a wave of AI-related moves that reshape the tape. Lots of scale, spin-offs, and selective rotation to talk through.
Right. Two stories really framed the day. NextEra and Dominion agreed to an all-stock merger to create the world's largest regulated electric utility. And Meta said it was cutting about 8,000 jobs while shifting capital into AI.
Plus, Dell expanded its so-called AI factory with Nvidia to push enterprise AI agents into production. When you put those three together, the theme was clear. Scale and capital allocation around AI beat the usual earnings headlines.
So let's break that down. First up, AI is bifurcating capital allocation. On one hand, Meta cut staff to reallocate cash into model development and infrastructure. On the other, Dell is industrializing AI so companies can actually buy repeatable solutions.
Exactly. Analysts noted the layoffs create short-term execution and PR risk, but they also signal conviction that AI will be central to growth. Meanwhile, Dell partnering with Nvidia turns prototypes into products. That gives analysts tangible revenue levers to model.
That split is interesting because it forces a trade-off. Some analysts worry that rapid build-outs pressure margins, especially with big GPU spends. Others emphasize the revenue upside once deployments scale and recurring services kick in.
So investors are balancing headline cost cuts versus industrialization that expands the addressable market. It's not one or the other, it's both, and timing matters.
And the number that really caught our eye on that Meta call was the roughly 8,000 jobs figure. A big reallocation move.
Yeah, that tracks. It's bold, and it raises the obvious question. Can you cut people quickly without creating execution drag on complex AI projects?
Right, because the big cost centers for these companies are not just headcount. Analysts reminded us that GPUs, data engineering, and energy for inference are huge ongoing costs. Headcount reductions shift the mix, but they don't eliminate those capital needs.
Switching gears, we also saw selective rotation. Winners from AI momentum weren't just big tech leaders. Staples like Pepsi and Apple were mentioned as beneficiaries of momentum frameworks, which is subtle and interesting.
The takeaway there was that rotation was selective, not broad-based. Screening for valuation and momentum mattered more than blanket sector bets. Active selection seemed likely to outperform passive exposure in that environment, at least according to market commentary.
Right, and that means momentum flows can show up in places you wouldn't normally expect. But some skeptics said those moves are fragile. Liquidity and headline flows can reverse quickly if macro risk picks up.
Now for corporate actions reshaping valuations. Honeywell announced a planned spin-off that analysts framed as a potential value unlock. Investor materials highlighted a few numeric signals, about 17.45%, about 8.38%, and essentially flat at 0.03%, that people are using to model split valuations.
Spin-offs are classic event windows. They can lead to re-ratings if markets assign higher multiples to purer businesses. But there are transaction costs, tax questions, and execution risk. Some analysts are optimistic. Others are more cautious.
And then the NextEra Dominion all-stock merger raises a lot of regulatory and rate-making questions. An all-stock structure preserves cash, but ties the combined company's value to share price paths and makes earnings per share dynamics a bit complex.
Right. Analysts agreed the tie-up materially changes the utility landscape and that regulatory scrutiny will be intense. Consolidation can deliver operational synergies, but utilities operate under rate regulation. How cost savings flow to customers versus shareholders is a central modeling issue.
Let's hit cyclical sensitivity, which was another major theme today. Home Depot was in focus as investors pulled back on housing expectations. The stock was mentioned around $355 as examples of how fragile expectations are heading into results.
Not a great day for housing-sensitive names. And CNH Industrial showed the flip side. A first quarter surge with metrics like about 4.35% and an investor note citing about $510 which highlighted cyclical upside in agriculture and construction equipment.
But cyclical names remain sensitive to macro swings and inventory cycles. Avantor slipped after guidance missed. The share price was reported around $20.38, down about 1.5%. A reminder that guidance still moves industrials lots more than headlines sometimes.
Short reaction.
Big move.
Wow, that's big.
We also saw small cap and niche stories draw attention. Frequency Electronics got renewed focus for non-GPS navigation timing systems, and Photocure had clinical updates at AUA 2026 around blue light cystoscopy benefits. These are reminders that discrete regulatory or clinical signals can be material for specialized names.
Yeah, pockets of alpha are forming away from mega cap tech. Active managers and traders noted that momentum signals in small caps can be transient, though. Liquidity and news flow are critical risks.
Let's summarize where analysts agreed and where they diverged. Agreements. Most analysts said the utility merger is a game changer that will invite regulatory review. They also agreed Dell's move with Nvidia meaningfully advances enterprise AI commercialization, and that Home Depot faces a tough housing backdrop.
Divergences were mainly about timing and profitability of AI scale. Some think restructuring like Meta sets up better returns long term. Others worry that CapEx and inferencing costs will pressure margins before revenues catch up.
Another divergence, whether spin-offs produce immediate value. Honeywell's plan is framed as a value unlock by some, while skeptics point to execution and timing risk. And finally, the breadth of rotation. Is it broad participation or narrow momentum? Opinions split there too.
Let's give listeners some plain language context on mechanics. All stock utility deals swap equity rather than cash, preserving cash flow but diluting per share accounting until synergies are realized. Regulators ultimately decide how rate cases incorporate cost savings.
Meta's workforce cuts reduce recurring personnel expenses quickly, but for big model builders, GPUs and energy for inference remain major ongoing costs. So the staffing move reallocates dollars. It doesn't abolish the capital intensity of AI.
And Dell plus Nvidia is about moving from proof of concept to repeatable enterprise sales. That implies longer sales cycles, but also recurring revenue streams from software and managed services, and higher GPU attach rates per server sale.
Spin-offs can let the market value each piece more accurately, but they come with transition costs and can be volatile in the near term. So the eventual outcome depends on execution and capital allocation after separation.
Quickly, what this means for different investor types. Long-term growth investors should incorporate AI adoption scenarios and cost curves into their models rather than extrapolating short-term momentum.
Income and yield investors need to monitor the utility merger closely. Consolidation can offer scale, but regulatory constraints could limit dividend expansion in the near term.
Value and event-driven investors should model pro forma financials and regulatory timings around Honeywell and the utility deal. Those events create asymmetric return windows, but timing matters.
Active managers and traders should stick to a stock-by-stock approach. Selective rotation and niche winners argue for active selection, but momentum is often fragile.
And cyclical investors keep an eye on guidance and inventories. Home Depot and CNH headlines showed how sensitive these names are to macro shifts.
Before we wrap, a few strategic considerations. Prioritize your catalyst calendar. Home Depot earnings, Honeywell spin-off timing, regulatory filings for the utility merger, Meta's quarterly cadence on AI spend, and Dell's go-to-market milestones.
Scenario plan AI outcomes. Make conservative, base, and optimistic cases that account for CapEx intensity, operating costs, and time to recurring revenue. Real options thinking can help quantify upside and downside.
Watch guidance sensitivity. Companies that revise guidance frequently create short-term volatility. Position sizing and risk discipline matter for traders.
And finally, separate headlines from durable change. Not every corporate action immediately alters fundamentals. Distinguish between one-time structural moves, transient momentum flows, and durable shifts in business models like enterprise AI commercialization.
Quick reactions to close. Honestly, I was a bit surprised by the scale of the utility tie-up. That's a regulatory story that will play out for months.
Yeah, and I was struck by how Meta's cost moves and Dell's industrialization arrived on the same day. Two very different paths to the same AI endgame.
All right, takeaways. 1. Markets closed up and down on select narratives, but the big theme was allocation to AI and the mechanics of scaling it. 2. Corporate actions, spin-offs, and mergers are shaping sector valuations and will invite detailed modeling. 3. Cyclical sensitivity and guidance remain primary short-term drivers.
And 4, active selection and scenario planning matter in this regime. Momentum will create trade opportunities, but durable returns will come from careful valuation work and attention to regulatory pathways.
That's our wrap. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. We'll be back after the next market close with more analysis. Stay curious.